The US economy has achieved an incredible level of growth since the end of the pandemic, and it has been so significant that it has overshadowed that of the other North American powerhouse, Canada. The Canadian economy has always been known as a well-oiled machine. Its GDP has grown at much higher rates than most G7 countries, and not content with this, Canada was also one of the first countries to recover from the 2020 crisis. Who should we thank for this unexpected success? Could it be that the policies of Justin Trudeau's government were the key to overcoming the crisis? Well, probably not. In fact, long before the Progressives came to power, Canada already had a reputation as an untouchable economy in the face of external recessions. An example of this is the 2008 crisis, where its GDP experienced much smaller declines compared to its G7 counterparts. Regardless of whether the right or left is in power, the Canadian economy seems to be rocketing forward, improving year after year, largely unaffected by the troubles of other nations. But things have started to go wrong. In fact, if you were to speak to a Canadian right now and tell them that their country is one of the most prosperous in the world, they probably wouldn't believe it. The reason: wealth per capita has been stagnant for several years. Canada's per capita GDP has shown one of the most disappointing performances among developed countries over the past decade, even lagging behind nations with clear issues, like the United Kingdom. The worst part is that, during 2023, real GDP per capita dropped by almost 2% compared to 2022. In other words, a full-blown recession. So, the questions are clear: why is the Canadian economy in decline? What has changed? Hello to all the community of Finance for All, welcome to another video. First, if we want to understand Canada's current situation, it is essential to look at how its economy has grown in relation to its population. For almost a century, Canada has become one of the most welcoming countries for immigrants worldwide, receiving over 250,000 people in 2014 alone. To give you an idea of what that number means, according to World Bank data, more than 1 in 5 people living in Canada in 2015 were born in another country. But before pointing fingers at immigrants as the cause of all the nation's problems, let's remember that this doesn't happen in other countries. Cases like Singapore or Hong Kong demonstrate that an economy can welcome thousands of people each year without this hurting income levels. And this is precisely where the problem lies: the Canadian economy hasn't grown as much as it should have. If we look at the data, most of the recent GDP growth has been thanks to the increase in workers, that is, the arrival of immigrants. Meanwhile, productivity improvements have virtually vanished. In other words, the Canadian economy hasn't fully realized its potential, or at least not as much as other countries would have. The question is, why? To understand this, we first need to ask when the problem began. Up until 1980, Canadian productivity levels were almost on par with those in the United States. However, it was after that point that things started to fall apart. What happened after the 1980s for Canadian productivity to plummet? Let's break it down. A productive economy requires large amounts of investment, buying machines, computers, network infrastructure, elements that allow us to produce more and earn more money. Economists call this process capital accumulation, and it's one of the main reasons why modern societies have been able to dramatically raise their living standards over the past 200 years. The question is, what is the current state of investment in Canada? Well, the news speaks for itself. The Canadian economy lacks entrepreneurs willing to risk their savings to grow their businesses. Among developed economies, Canada stands out for having one of the smallest and most cautious business sectors of all, with private investment below 50%. And do you know the worst part? It's not just that local businesses are unwilling to invest, but foreign investment is also following the same trend. Since the year 2000, foreign capital inflows have plummeted, dropping from over 9% of GDP to less than 3%. This decline in both internal and external investment is one of the key factors behind Canada's economic downturn. But how is it possible for this to happen in Canada, one of the largest economies in the world? Why have investors, including those from its neighbor, the United States, lost interest in the northern country? The answer, unfortunately, is a classic: excessive regulations. Destructive state interventionism is nothing new. To put it nicely, regulations are like a layer of snow. In small amounts, it's charming, but when there's too much, it becomes annoying, and if there's way too much, it can even be dangerous. And in the snowy land of Canada, regulations have become just that, dangerous. Canada is, by far, one of the most closed countries to foreign investment in the world. Its level of restrictiveness is so high that it nearly triples the OECD average, easily surpassing even the United States, Japan, and France, combined. Paperwork, approvals, licenses, fees, permits, taxes on everything you can imagine. The bureaucratic and fiscal web is so suffocating that it alone has destroyed the incentives for investment. But do you want an example? There's the supply management system in the dairy and poultry industries. This system limits the amount of products farmers can produce through a quota system, which keeps prices high and restricts free trade. And like this regulation, there are many more. The result? According to an article by the International Monetary Fund, internal trade barriers between provinces alone impose costs equivalent to a 20% import tariff for each province. In other words, the Canadian state is so extensive and bureaucratic that its own territories interact with each other like a more closed market than the European Union itself. But there's more. Not only is investment low, but the little investment that exists is not directed towards exploiting the best available opportunities. On one hand, Canada is one of the countries that spends the least on research and development in the entire G7, surpassing only Italy, which doesn't exactly have the most prosperous economy in the world either. On the other hand, the Canadian economy has undergone a process of de-industrialization like never before, from the early 2000s to today. Its manufacturing sector, one of the highest value-added parts of any economy, has shrunk from representing 17% of GDP to less than 10% today. At the end of the day, if some of you owned a business and the state came to take most of your profits, prevented you from investing, and imposed absurd regulations on everything you did, would you take risks in an ultra-competitive market like tech? Or would you prefer to stay in sectors with less potential but more security? Exactly, high-value sectors don't thrive. Almost no one in Canada wants to risk their money in AI or industry. So much so that the percentage of high-tech exports from the country has deteriorated significantly since the 2008 crisis, when state regulations and investment restrictions began to become increasingly pervasive. Now, what if I told you that not all the blame for this decline lies with the Canadian government? Canada faces another major problem that has prevented it from competing and adapting: the brain drain. Being neighbors with the US, Canadians have access to one of the most competitive labor markets in the world. And of course, the highest salaries in Canada pale in comparison to their US counterparts, especially for high-level professions like surgeons or engineers. To give you an idea, last year, according to Canadian census data, only 10,415 Americans moved to Canada, but 126,340 Canadians moved to the US. And of course, all these people aren't moving to the US just for pleasure, they're going for work, better salaries, promotion opportunities, and even lower taxes make migrating south of the border an appealing professional destination. Conclusion: Canadian companies are left with the crumbs, while the best professionals, trained in Canada itself, leave the country. In short, the Canadian business sector has been weakened over the past few decades due to massive amounts of state intervention, regulations, and taxes, leaving the country's productivity levels in the dust. If Canada wants to get out of this crisis and grow in more than just GDP, it will need to improve this bottleneck in its capital accumulation cycle. But until then, it's your turn. Do you think Canadian productivity can break out of its downward trend? Do you trust that the government will find a solution to these problems? Leave your opinion in the comments.